Okay, chapter 2. We're looking here at this, we're throwing ourselves a bit more into the idea of the conceptual framework. Let me just change my pen color, just because. Let's go for red. So, we're looking a bit more now at the conceptual framework, types of business organizations. You might know this already, but it's important to just do all the questions relating to this, right? Okay. So what does the conceptual framework actually say? So like I said, the truth is we've always had standards, and the truth is actually we actually started off with concepts, right? Which you would, if you were doing level 3, you might have come across level 2, level 3. You would have had to kind of understand the basic accounting concepts, and some of the concepts. Whenever you ask what's a concept, if you like, almost what's an idea, what's a guide. Remember, accounting is not a natural science, so in a way we had to come up with some ideas to put some structures together. So we're talking about things like accruals, going concern, money measurement, realization, objectivity. Yeah, so those are your kind of key ones. Accruals, business entity, that sort of thing. These are your concepts. So we started off with this and thought people would actually just abide by these. Prudence. How can I forget prudence? Prudence. These are all concepts. So the truth is we wouldn't need, if we just followed these concepts, we wouldn't need even standards. But people don't follow concepts, so we needed standards. So standards, so we said, okay, IAS 2 says this is how you treat this. And if you look within every single standard is based, of course, on the concepts. It just has to be, right? The concepts drive the standards. So you have all your standards ranging from IAS 2, IAS 7, IAS, you can carry on. And that's what we're really looking at. If you look at this chapter, a lot of these are IASs, but a lot of them are based on the standards. The truth is, always go back to the concepts. Sorry, a lot of them are based on the concepts. Always go back to the concepts when you're trying to understand a standard. And sort of look at it for yourself and prove it. Another very interesting standard is IAS 10. You know, a lot of people don't like this one. When I say don't like it, they're thinking, is it, should it be? Just think prudence. Just think prudence. Once you think prudence, it'll guide you. Will guide you. Remember, the stakeholders are really key to sort of the conceptual thinking behind this. How can our accounts be relied on? Are they relevant? What would someone looking from the outside see with a set of numbers when making decisions? Okay, let's push on. Outline the principles, concepts that can be used in developing or applying ISR standards. Again, like you see here, it says the framework states that the objective of financial statements is to provide information on the financial position and performance of the company that is useful to a range of users. That's the key point here. And here we just fly through a range of users. I mean, you know these. I'm not going to bore you. Investors, we know who they are. Lenders and other creditors. You can see the key point is that everybody wants to look at a set of financial statements, assets, liabilities, and if you like equity, and income versus cost of sales, GP, or profit, or operating profit, and then you have your other sort of finance cost and tax, and then you have profit for the year. So one wants to be able to look at these and trust these numbers, trust what these numbers are saying, and then make a decision based on that. So which is where ratios come in. So ratios will come into kind of the issues with lenders. They're all very much interconnected. These are other stakeholders, right? Government, employees, customers, public. Now, they break it up like this. I think it's fine to do it this way, but overall, not that you need to know the core detail, but you need to be very comfortable with what's going on here. Okay, great. So what are we saying? We're saying that really, how I used to teach this, how this used to be taught was that, okay, listen guys, they're accounts, because the users need accounts to be 4 things: relevant, reliable, comparable, and understandable. Because you think about it, right? When someone picks up anything, they want to be able to understand what's going on. They want to be able to use it, compare it to another company, or to make a judgment. But to do that, the figures have to be kind of reliable, and they also have to be relevant. When I say relevant, to the time, there's no point in picking something up that's been valued in 1950 and it's still 1950. Or just the idea of being relevant in general, right? If you're not relevant, blah, 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 the same usual, nobody wants to listen to your music or whatever. So, key point. There you are. So that's where we're going with this. So and kind of see the connection, the relationship here. This idea of the framework identifies 2 fundamental qualitative characteristics, qualitative, fundamental, almost ethical the financial information, and then 4 enhancing, and that's fine. So the fundamental characteristics are this idea of relevance, and faithful representation. I'd probably call this reliable. But the point is that you can see the definition of these: complete, neutral, free from error. And let's look at the next one. And then it talks about enhancing qualitative characteristics. So it talks about comparability, which I talked about, and understandability. And then it includes two more, because now we're at higher levels. So we're talking about verifiability. We can actually, it says this provides assurance regarding the reliability of the information, and it's in time for you to be able to make decisions. You have it there. It's not dated. I mean, financial statements already suffer from already being very backward looking, and sometimes you need information, of course, for the future. But so you can already see that the fact that you already, these will end, for example, year end December, and you're only sending out this information to your shareholders probably in February is already late. Although, to be fair, a lot of things are now done online, so you can still have future information regarding an organization if you want to. And now we finally have what we refer to as an underlying assumption. This is just an assumption. We just argue that, well, organizations will carry on for the foreseeable future. You know what going concern is. But this is, so you can see here, let's start again very clearly. We're talking about qualitative characteristics, underlying characteristics instead of financial statements. This fundamental, and this is an assumption. There's no question about it. You shouldn't be even, I just assume. I'm not going to ask you. I assume that you will be here for the foreseeable future. Okay, quickly, you know what assets are. I mean, you shouldn't be on the course if you don't. You know what liabilities are. You shouldn't be on the course if you don't. Now, what you might not be comfortable with is this new definition. And it's really important. A resource must be controlled. It's this question of control. Right? This is the new definition. So you have to stop saying things like, oh, an asset is something someone owns. That doesn't even work, right? What you have to be saying is a resource is controlled. Now, here's the thing. Not just controlled, but what's the situation? It's as a result of a past transaction. So say, for example, you can't say, what this is really saying is, you can't say, oh, I'm going to buy an asset next year. So because you say I'm going to buy an asset next year, you put it on your statement of financial position because you have this intention to buy something. No, they're saying that you've already bought the thing. So you say if you bought it on Monday, on Tuesday, it's yours. So it's the fact that we're looking backwards and saying, oh, we had a past transaction, we've done this. So you can see the financial reporting is trying to cover strange things that people do, if you like, or what legal contracts can allow for, but the ethic, the characteristics of accounting won't appreciate. If you like, the characteristics of the concepts won't appreciate this idea. So it must be as past transaction, and also it means that future economic benefit will flow to it. So as a result of you buying that machine, money will flow into, or economic benefit at least, whether it's a saving or whether it's actual generation of funding will flow. And this is what you need to learn. You just have to learn this. But the same idea applies. So a liability, so you take out a loan. As soon as you take out a loan, you now have an obligation from now on. So as soon as you're taking out a loan, by the next day, you have an obligation there as a result of what you did. And in the end, the settlement will require you to actually pay some money out or pay something out to someone. So these are the ideas you need to. I accept that these might be new, but these two words, you have to have known them all the time. And equity really is A minus L. A minus L is what the business owns minus what it owes. That's what, if you like, equity really is what's the value of the business. What is the ownership of what belongs to the actual, what's left, if you like. I always try and use the example of a house. If you think about it sometimes, if you go and buy a house, they might say to you, oh, you bring £5,000. Say, for example, it's a really, let's just say it's a shed, and you want to buy a little shed in a little house. You want to buy a shed in a little house in London. So they say to bring 5%, a 5% deposit. So you have something that looks like this, 100,000. So this is A, and this is E, and this is L. Oh, sorry, well, when I say E, this is C. So this is your £5,000 deposit. You've taken out a mortgage of 95, and yes, the house is yours. When you look at this, say this is our accounting equation. Nothing's changed. When you look at this, you say to yourself, well, someone asked you, what you go around probably saying to people is that you have a house. True. but you also have a mortgage of 95. So really what's left or what's yours is 5. That's the meaning of equity. What's yours, right, in this whole picture. And you're hoping, I imagine, that this should go up by, hey, 150,000, because we live in a crazy housing market, and that straight away will increase your equity by another 50, so that that should go to 55. Or sorry, 40. Yes, 55. That's what. Yeah. So automatically your equity can increase. Of course, if you sold the house tomorrow for 150, you pay off the loan, you walk away with 55. So you can see how equity is defined. Right, and the statement of, you know this already. A minus L is equal to E, if you like. This is what we refer to as statement of financial position. We used to call this the balance sheet, didn't we? We used to call this the balance sheet. I'm trying to make this every 10 minutes. I won't stay too long. Just bear with me. And here we are. You can see what it is, right? You know the layout. Non-current. You must know the layout. You must. You just must. You must know the layout. You did this at level 3 as well, but you must know the layout of your assets, your statement of financial position. So you have non-current assets, you have your current assets, if you like, and then this gives you your total assets. And then you have your equity. I mean, slightly different layout. I would probably have gone for, when I say different layout, things are changing a little, but you want to be comfortable with both. It's really irrelevant. A minus L is equal to C. A is equal to C plus L. They're exactly the same thing. So you should be totally comfortable with whatever layout you're presented with. So you have equity here. When we talk about equity, it's very possible, of course, that when money comes into an organization, that if you remember, we'll come across it as well, but from level 3, definitely, and other initial study, every organization will have a nominal value, a face value of shares. So if their face value is £1 and someone, that's the the value of an ordinary share of the face value. Yes, someone might pay £1.50. Well, if someone pays £1.50, we record the £1 in share capital and we record the 50p in the share premium account, right? And this, of course, allows us to always know what the number of shares actually are. Revaluation surplus, of course, this is fundamentally has to do with increasing the value of an asset, but the money, you've not sold the asset, so you can't quite realize the profit just yet, so you create a reserve. So, for example, imagine you have a building, like I was just talking about, you had a building worth 100,000. And you paid for it. I just call this bank 100,000. Let me just change my pen color. And let's just say that the house suddenly, the building went up by 50,000, like I said earlier on. Well, you can't recognize 50,000 in the income statement just yet because you haven't sold the house. So you create something called a revaluation reserve. So we have 50 here, and we have, and we have 50 here as well. Like, now look at what happened. Look at what I did over here earlier on very quickly. When this went up from 5 to 55 over here, I mean, it's still under C, right? It's still under equity. It's not quite in C, but it's the revaluation reserve. That's the classification, and classification is important. It's important. So you can see here, that's your revaluation reserve. That's why it's under equity. That's why it's being added on share capital. So overall, it is yours. If you chose to sell the house or the whatever it was, you will realize that profit. But in the meantime, it's kept in a revaluation surplus. And then, of course, we have our long-term liabilities, and we have. So this is really about layout that you need to be comfortable with. So practice writing this layout. And you'll see questions. The questions I set for you hopefully will expose you to that as well. But you must be comfortable with the layout. Yes, but ultimately, again, it's A. Here it seems they're doing A. You can see here total equity plus liability. So they're doing A is equal to C plus L. It doesn't really matter how you lay it out. Ultimately, follow what you're given and know both. Know both. Here we are. So current liabilities, you know what they are. These are things you still owe within 1 year. And you hope to pay it within the year. These are greater than 1 year. So classification is really important. So when you take out a loan, financial reporting requires you split the loan out into what you will owe within 1 year and what you will owe for the rest. So you just have to kind of spend time just breaking down clearly, because the reporting requires that breakdown. So income statement, expense, I'm not going to waste my time with that. You know what that is. Statement of profit or loss. What you do need to recognize, of course, is that sometimes you make other sources of income that are not to do with, if you like, profit or loss. The statement of profit or loss is really to do with trade or expenses to do with trade, and sometimes other things arise, if you like, that literally debit bank, and we can't credit income. We kind of credit something else, some other type of income, and we recognize those within comprehensive comprehensive income. So you can look at this again. Like I said, the difference, of course, with from a sole trader is the fact that we have a different sort of breakdown. I think we've been going on to 20 minutes. Sorry, this is the nature of level 4. It's a bit more. So you have revenue, cost of sales, you have your gross profit, you have these two sets of, these are classifications. So you will chuck in a range of expenses in here, won't you? And then you have what's referred to as profit from operations. So start learning the layout, right? So you can see here that after gross profit, you will have, I mean, it doesn't really matter. I used to think there were 3. Your exam just has 2: selling, administrative, and distribution. SAD, I used to recall this using SAD. Selling and marketing, but there's no marketing. The key point is that because they're really big companies, think about a listed company, they can't start writing light and water and heat. That's ridiculous. So after deducting these expenses, you now have what's referred to as profit from operations. Then you now have finance costs. So all your interest costs, if you like, whether or not it's been put through, you have to accrue it if it's not been put through, but you have to be thinking on your feet, thinking, if we've taken out a loan, well, there must be some finance costs. So that's what you put there. And then you have profit before tax, and this is what the tax will be for that year. It's income tax expense. So for example, if your profit for the year is, I don't know, 100,000 and tax is 30%, then this should be 30,000. It's irrelevant. It's an accrual, isn't it? Debit tax expense, 30,000. Credit tax liability, 30,000, because you wouldn't have paid your tax by the end of the year. But you still need to. The accruals concept requires you to still record the fact that you have tax to pay, and then you have profit for the year. Then, like I said to you, then you have this other comprehensive income. Here they've got revaluation surplus. So I'm gonna have to check that out a little, but. Typically, any increase in the revaluation, or if you like any other foreign exchange, if you like, that's come in, for example, would come in here. But the key point of separating this is telling this is not to do with trade. So you see clearly saying there's more formalized terminology, and the capital structure, of course, is different to that of a partnership. And that's true, right? Because let's look at let's look at the equity section. You will never find share capital in a sole trader or partnership. You won't talk about share premium. Yes, you have we don't even call it retained earnings for sole traders. You say profit, and you probably won't have a valuation surplus for sole traders as well. Right. So quickly, let's quickly go through this. So this question of realizable. Oops, sorry. Let's just go back a little. So the framework says, right, that in terms of recognizing things in the income statement, recognizing things in the financial statements, we need a couple of things. This question of probability, right? We need to. This is the reason why we have things like bad debts, because if it is probable means greater than 50% in terms of probability. So if it is probable, right, that you're going to get something, then you can recognize it, as in actually put the number in. This is the issue here. If you're not sure, if there's a less than 50% chance, then you can't put the number in. Because you see, you must remember that once you put a number in a set of financial statements, you are creating assets. You're creating income or something, and people will rely on this. Also, this is a question of, can we measure what you're doing reliably? This is really testing objectivity. Right. So any of these provisions or increases, it has to enjoy the fact that it's probable and it's reliable. Right. And we'll see examples of this when we look at IASs. But these are conceptual. Once you're thinking about this conceptually, when we start looking at certain IASs, typically whatever provisions or whatever it is or liabilities, you will know. You will start to think. You should start to think about the fairness of needing this event to be probable, that it should be able to happen before I want to recognize it here. It's like telling someone that, I'm expecting some money. How probable is that? You go into a bank saying, I'm expecting some money, increase my overdraft. If it is a greater than 50% chance, then you should say so. If there is less, then you should also say, well, I don't think it's less than 50%, but here I'm going. So costing. So typically in accounting, we recognize things at the price we actually pay for them. the historical costs, right? And this is very normal. This is a concept. It's one of the concepts with prudence and with all the others. In some circumstances, you might need. This becomes policy. You might actually change and say, listen, we're going to recognize things with what the current is and not the historical. And it depends on the instrument we're talking about. So we might be in financial markets, for example. And so you can imagine financial markets are very different from, if you like, very steady markets like whatever other raw materials that you're buying where the prices don't change very much. But if you're in another completely different market, we must be able to adapt to enable us, because we need the accounts to be relevant in the end, which is why giving ourselves the option of current costing is important. Right. So sometimes when we come to talk about things like IAS, what am I saying? You've done IAS 2. IAS 2 says we should always recognize inventory at the lower of cost and net realizable value, right? And this is simply because, for whatever reason, the historical cost is much greater usually. If that's why we have this problem in the first place. So we have a problem. So net realizable value kind of helps us to, in terms of prudence, because you can't be recognizing something in income statement at 5,000 when really all it can sell for is 2,000. So it's only prudent to knock this out and put 2,000 in, right? And that's kind of what's going on, really, as to what we're saying. And this is another concept, again, like I say, depending on what product you're dealing with. And I can discuss this in greater detail, but this is just an understanding that we must be flexible. Present value is really saying that, well, what is the value of something? And really, let me give you a nice little example. Imagine you buy a car for or you buy a car for £10,000. You see what you're really saying, right? Yes, you paid £10,000 now, but that's not what's really going on. You're really saying, right, that I expect this car, if you're using it for trade or machine, or let's say you buy a machine for £10,000, at least you are expecting this machine to bring you at least £10,000 over its life. Because you wouldn't have bought it. Because if you pay £10,000 for a car now and it's not going to bring you, so whether you say something like it's going to bring me 2,000 at least next year for the next 6 years, that's the only reason why you then think, yeah, then it's worth it. When you say it's worth it, you're comparing the future income with the present outflow. You're saying, I'm going to compare the 2,000 over 6 years with what I've paid for it now. So this idea of present value is saying, can we get a value of these 6 amounts today, if you like? So this 12,000 probably could look like, I don't know, what is 12,000 today? You might say it's really worth 11,000. It's really irrelevant. But the key point is you're comparing the present value of all these figures with what you're spending today. And that's one way of thinking about recognizing things. Right, and we know what these are. Sole traders partnerships, limited liability partnerships. You can read up on this. If you like, these are partnerships that now have limited liability. You can read up on charities. Make sure you read up on public sector. Just know what those are. There's a professional code. OPIC, I've talked about this before many times. Yes, you should be comfortable with that. Integrity, objectivity. Well, when I say I've talked about it, even if you're doing another course, the key point is in your first live course, you would have studied this idea of the 5 key principles and these work for every single organization. And when I say organization, body, ACCA, SIPFA, CIMA, and AAT, all accountants will abide by these 5 key principles. So please quickly read those again and make sure you are happy. So we also have the reason why we want these, make sure you have these ethical safeguards, is that it's really important to make sure that you protect yourself from this, or else you're not going to be able to, if you like, give a true and fair view. So we typically talk about things like what's referred to as a self-interest threat. So this is really financial. So when you're being paid a lot of money, you're thinking about the money, and then you're likely to give the wrong sort of value on a set of accounts, or do what you really shouldn't do. This is you trying to act on behalf of the client. You shouldn't really be doing that. Don't get too close to your client. The closer you get to your client, the less likely you're able to kind of tell them the truth. Self-review is very much about you. Say, for example, you prepare the account and you also want to do the audit. Something along those lines. The key point is that you can't do if you, well, I guess for limited company, for listed companies, you can't do this anyway. But if it's not a listed company, then you can have two very clearly different separate teams. Yes, not a problem. And intimidation is when they're threatening you, that they won't pay you, your client is threatening not to pay you, and therefore you do the work because you want to get paid in the end. So so typically we have, if you like, the standards to guide us, these professional standards that we talked about, OPIC, of course. And just really, just the fact that they have corporate governance. So when we talk about corporate governance, there's a board of directors that you can speak to if you feel that the accountants aren't helping you within the organization. And just learning more and just having some better training and experience to deal with those threats. But you can please read up all of this. Okay, great stuff. So for this, the questions you need to do are question 10, question 12, and question 14 in your exam kit. That's the 2017-2018 exam kit. This has been a long one, but these are critical. You can't ignore them. So please make sure you do those questions and you're comfortable with that as well. Okay, great stuff. See you in chapter 3.